makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Global stocks head for their best week this year on more soft inflation data from the U.S. and bets that the Fed's hiking cycle is nearing an end. Earnings season kicks off for Wall Street banks with results from JP Morgan, Citi, and Wells Fargo due today. We'll bring you any of the pre-market moves this hour. Plus, Burberry shares are lower as the luxury coat maker sees a muted rebound in China and declining sales in the Americas. Now let's take a look at the European markets map. It's been a big week. So first of all, happy Friday. Also to the French viewers watching us, happy Bastille there. Now, if you look at some of the differences in terms of the FTSE 100 compared to the CAC 40, that is getting some 0.3%, and the DAX, which is down 0.2%, they're pretty minimal given the week that we had. Now, this is a week where we saw two inflation prints in the U.S. pointing to more price stability. So investors now trying to figure out whether after the hike in July for the Fed, which is 24th, 25th of July, pretty much priced in, whether we still need, like Mr. Waller says, two more hikes or one more hike after that, or whether there's a little bit of a pause. So if you look at the week that was, this is what caught my eye. First of all, the U.S. two-year yield yesterday was something to behold, because if you look at the 7-day mark, we did touch 5%. That was July the 6th. And then you can see as the inflation prints came this week, we're now at 4.60. So 40 basis points in terms of a change there. The impact, of course, is as investors need to try and figure out if the Fed is now paused, but whether we're seeing cuts in the next 6 to 8 months or whether we stay there. Now, the other story, of course, is dollar. This has a huge implication as we go into the earnings season, because it changes everything for example, companies that have to repatriate and go back and report in their currency, such as the big luxury groups here in Europe. So some of the major currencies compared to, for example, the dollar, you can see Norwegian krona, 6.14 spot returns. Swedish krona, also some of the big moves. But if you look at pound, and we talked quite a lot about pound because of the GDP figure and some of the CPI figures as well. I mean, it's nothing to be snub about. This is quite a big day in terms of the week that was for dollar weakness. And finally, it's earnings. So we have a lot of the banks later today that starts reporting with JP Morgan and Citi. But this is one of my favorite charts. It's looking at the earnings recession. And this is basically expectations that Bloomberg Intelligence puts together, expectations on the per share growth, on the earnings growth that we can expect in the second quarter. And of course, it doesn't compare favorably compared to a year-on-year number compared to last year. But it'll be interesting to see the breakdown of this, if it's healthcare to banks, and what that means for example, margins. Now, the largest U.S. banks weathered a punishing first half largely unscathed. Now they just need to prove they can navigate a surge in expenses, regulatory changes, and price your deposits. Later today and in the coming weeks, of course, we'll get some of the answers to these unknowns. JP Morgan, Citigroup, and Wells Fargo kicking off second quarter earnings season today. Now, for more, let's get straight to Bloomberg's Jan Patrick Barnett in Frankfurt. So, JP, exactly what are we expecting for some of these banks?
Very good morning. So what we are expecting is not a great picture, and we heard already, like from Goldman, something very unusual that the bank did is in preparing the market and its investors, that the quarter is not going to look great, and I guess it's going to be similar for the other banks as well, especially the big ones with trading activity. We know it's like tough comparables, but also the market is not like yielding very much for them in terms of client activity and margins there. And then of course we have all the legacy stuff. Let's say the fallout from March. We want to hear about like what regulation is causing an impact on capital and on earnings, of course. And then there's the whole topic of interest rates that also needs to be discussed with the banks, how they're faring in that environment.
So how is the yield environment actually challenging some of the interest rate expenses?
Yeah, absolutely. I mean, it's becoming a little bit of a two-edged sword for the banks. I mean, like the positive impact from higher yields on net interest income and net interest margin is kind of getting more and more to as good as it is. And on the other hand, we have like since all the drama in March, we have seen a higher competitiveness when it comes to client deposits. So banks have to pay up on interest rates there, and that's of course eating into their bottom line.
So what's the impact from some of the new regulation that could come in place, especially in the U.S.?
Yeah, that's the most interesting topic for me, to be honest. And I think like we need to get lots more details from the CEOs and the CFOs, how they fear, how they are going to handle that matter. I mean, the banks overall in the world, and especially in the US, are well capitalized. But still, it's not clear how the new regulation will look like. And it's going to be very interesting to hear from the top executives, like how they're preparing for it, what their expectations are, how they will handle dividends and buybacks going forward, if they are more cautious to just be on the safe side, if there is like tougher regulation upon them, or if they feel like very easy about this. So this is not going to be about numbers. This is going to be about the outlook and what they're telling us, and that's going to be, for me at least, it's going to be the most interesting part in that earnings season.
JP, thank you so much. Jan Patrick Barnett there in Frankfurt. Now, coming up, we'll be speaking to Mike Santomassimo, Wells Fargo CFO, after the Wall Street Bank also reports. So it'll be interesting to get his thoughts also on costs and, of course, some of the products that they could put on the market or not. Now, U.S. producer prices barely rose in June from a year earlier. It's really another sign that inflation is cooling after CPI came in at the slowest annual pace since 2021. The figures will likely comfort Federal Reserve officials while boosting market hopes that the hanky campaign is near the end. Well, joining us now is Georgina Taylor, head of multi-assets at Invesco. Georgina, great to have you on a big week. I mean, it was a huge week in terms of CPI and repricing, and yields are all over the place. Is the Fed one and done after that July hike?
It feels like that should be the narrative, and I think everyone is hoping that that's the narrative. I mean, what's so interesting about this week is it's what everyone has been hoping and waiting for, because we're all anchored in that environment of we know what to do when policy starts easing and lower interest rate environment. I think it's probably too soon to call that. I think things are still quite open post that meeting, and I think we're still in data watching mode. Does one print really tell us that we've won the battle? I'm not so sure.
Yeah, so how do you see it like panning out again? And I was in Sintra, and it was incredible for the markets to price cuts, and a lot of these Federal Reserve officials that were there trying to really push back and saying, look, we need to get inflation under control. Is there a worry that inflation drops quickly because of all the hiking we've done so far that is very difficult to model?
I think it's difficult because there's not a short, sharp shock that is feeding through economies right now. That is what's so difficult. It's almost like this slow drip feed mechanism that one sector of the economy gets impacted by tighter policy, others have a bit of a buffer. So, for example, there's been huge savings rates, so we haven't quite seen the hit to the consumer yet. Even with mortgages, there is this delayed reaction to higher rates really feeding through to someone's pocket and their spending. So for us, that makes it quite a difficult environment in terms of investment. So I think, yes, we think things will start to, it's got to be about the growth narrative now. Is inflation slowing because actually demand is softening meaningfully? If there is genuine evidence that that growth dynamic is shifting, that's when maybe policymakers have to change their rhetoric, but that just isn't happening yet. It's not clear.
And Georgina, I guess, you'll start seeing it in earnings, right? They're not lagging kind of the economy, but they could give us a good indication of what chief executives worry about for the future.
Well, exactly. And if chief executives don't have confidence, they are not going to spend money. And I think what this economic environment needs is investment. And so if we don't have the confidence of the corporate sector to really start planning for the future, then again, that just pushes out the recovery. And so that softening in growth doesn't have an offset anywhere coming through. So I think earnings will be key. But coming into this year, we all thought earnings would slow, and they didn't. And so it keeps getting pushed out quarter by quarter. So the bulls have got more confident because it hasn't happened yet. The bears have got slightly more cautious, thinking, if I just got this wrong. But again, I think it's just that drip feed mechanism. It might not be all sectors in one go. So it'll be sector by sector. We've got to look at the evidence of margin risk, top line growth, and really start piecing that jigsaw together as earnings season plays out.
And Georgina, I guess dollar weekness was a big story. I don't know whether you expect that to last. There's also U.S. yields bouncing around a bit.
Yeah. So it's it's interesting because as a multi-asset investor, the US dollar was our saviour last year. You got away with quite a lot if you had some US dollar exposure. I think we just can't rely on it right now, and I think that interest rate differential story is wavering. But I would not give up on the dollar completely, because I think if the growth narrative takes hold, then the US dollar just becomes more attractive. And the absolute difference versus other markets is, could still be there. So I think don't give up completely, but maybe look elsewhere to balance the risks versus the dollar.
Georgina, thank you so much for joining us. Georgina Taylor, head of multi-asset at Invesco, stays with us, and we'll talk a lot more about China and China's prospects. Now, there is also one story that we really wanted to bring to your attention because I think it's a morning must-read. We talk about the economy every day, we talk about inflation, and sometimes it feels like we only focus on the numbers and we forget the people behind the stories. There was something that really caught our eye, and it's about rising homelessness in the US, but actually homeless families. I think the number is 30% higher compared to last year. And so there's this piece that we're pushing out in social media talking about US family homelessness and how much it's been risen. It's written by Augusta Saraiva, and I would really urge everyone to go and read it, to always keep in mind, of course, that the cost of living crisis also has huge implications for real people. Now, coming up, we talk about sales in the luxury space. Burberry reports a decline in sales from the Americas. So we talk luxury, we talk China next, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, Burberry has suffered a decline in sales from the Americas and a smaller than expected rebound in China. First quarter overall sales rose 18% in the last 3-month period, in line with estimates. The trench coat maker says it's mindful of the uncertain macroeconomic environment, I think is exactly how they put it. Well, here to discuss all of this is Bloomberg opinion columnist Anindya Novyan, who of course always focuses on retail. So, Anindya, what does this, good morning, first of all, what does this tell us about? Does it tell us more about the luxury market, or does it tell us more about Burberry because the chief executive is trying to revive it and we also have a new creative director?
It probably tells us more about Burberry than the broader market. The thing about Burberry is it's really focused at the moment on the premium sector rather than the super luxury sector. And it's the very rich that are spending. So in the US, for example, the US is weak because it's the younger, more aspirational shoppers that in past years have had stimulus checks, crypto gains. Those are missing, so they're reining in their spending.
Right, but Burberry doesn't have that kind of like haute couture. I mean, is it trying to go ultra premium?
That's exactly what it's trying to do. It's been on this journey to elevate the brand and elevate the prices, and they certainly have gone up. But it's got this new creative director, Daniel Lee. He did a very good job at Bottega Veneta. So all of the expectations are on him to repeat that at Burberry.
So, Andrea, you understand the sector really like few people in this business. How long does it take to elevate so that prices, I guess, for the ultra high net worth, there's no price limit? I mean, Chanel was putting up prices by 30%. So how long does it take for them to try and manage that transition?
It takes a long time. Now, there are some grounds for hope. The sector is sort of changing. We've been in a very maximalist, Gucci-driven environment, bold prints, logos. We're seeing the return to this quiet luxury, much more muted, classic.
Because of succession.
Because of succession. Also, just because of the economic environment. When we're feeling a little bit more downbeat, we are not quite as exuberant in our dressing. Now, Daniel Lee was one of the main proponents of that look at Bottega Veneta. And the other thing is, one of the real emblems of quiet luxury has been the trench coat. So Burberry's got those two elements going for it. If it can make the most of that, then it's got a good chance of success.
Andrea, really quickly on China, I mean, I don't know how much of their sales they do in China, and the fact that we're really uncertain about what the economic environment is there at the moment.
Before the pandemic, they got about 40% of their sales from Chinese nationals. That's now probably around 30%. China is coming back, had about a 50% increase in sales, but some analysts were looking for more. So this will be the big question as we go into the broader reporting period when we get LVMH, Kering. We'll all be looking for just how strong China is.
Okay, Andrea, thank you so much. You're looking very shiv. I mean, I'm a little bit obsessed with Succession. It's also like really driven some of these luxury sales. Our Bloomberg opinions, Andrea Novyan on Burberry and the luxury sector. Now, China's central bank has signaled more targeted support may be on the cards for the country's property market. The PBOC also moved to reassure investors in the real estate sector, downplaying the risks posed by the banks. Well, back with us also to talk China is Georgina Taylor, head of multi-asset at Invesco. Georgina, when you look at China, and again, we've had a lot of concerns in the last couple of weeks about the kind of the support that PBOC can bring to this economy. We heard some of the luxury sales maybe waning a little bit. Theater goers apparently is doing really well in China. Like, what's your take on China right now?
I think it is softening, and I think we have to accept that the growth story isn't going to be as strong in China. But I think the key for markets and investing is that everyone has been waiting for China to almost come in with this stimulus package, which would be very large, very obvious, very, have that kind of big impact on risk appetite. And I think that's not going to happen. It is again going to be this drip feed, as you say, these targeted sector measures. And so that's great for maybe balancing growth in China. So that's not a bad story, but it's not quite the impetus you need in terms of that huge boost to risk appetite. But I think at the margin we need to see, the big thing that's been missing is that it has been all about luxury goods and consumer spending in China. And that's been the big theme. We want to see that broadening out so that you do get some investment coming back in, because these sector trends have had huge impacts, particularly in some of the European indices. And so that's what we're watching for. But again, a slow drip feed, not really a one set of measures that will change the outlook for China.
Yeah, and we worry, I guess, about the infrastructure, the housing in China. And of course, that translates into whether they're also exporting deflation to the rest of the world.
Yeah, absolutely.
I mean, does it change your, if not asset allocation, the industries that you want to be buying into right now?
Yeah, I mean, I think that there is some. I think the thing that is underpriced is that there will be any investment coming through more broadly around the world. And I think one of the most obvious relative performances that we've had are something like France versus Germany in Europe, where France has been hugely supported by that consumer theme. You haven't had Germany maybe doing so well for some other reasons as well. So I think some of those trends might be set to reverse, but also finding themes where there is that targeted spending. So maybe infrastructure and trying to really focus in there rather than a broad base will hold all industrials. But I think it is the consumer side that looks expensive given some of the pressures. So we would look elsewhere. But again, doing it maybe a basket of stocks rather than a broad sector, and really try and access the theme that way.
Georgina, what do you do with tech right now? Is it in a bubble?
It's so hard. It's so hard. So, it's not even just about tech. It's what do you do with US investing? Because the concentration of these indices has been so great that we're all nervous that we have to become...
The Nasdaq's even nervous.
Exactly. We have to become stock pickers even when we're macro investors, and that's difficult. So for us, we think, look, this first phase of what's going on right now with the softer CPI print is everyone getting excited that that policy tension will at least be relieved for a bit. So you want to have some exposure to the interest rate sensitive indices, and you want some exposure to maybe that cash flow driven investing that we've had and visibility on earnings. So tech still stacks up on that. It has its own theme that is driving that sector. But we would do it through options, for example. We wouldn't get directional exposure both ways because the stress is still quite high in terms of those indices and investing. So we absolutely want exposure, but let's be a little bit more careful about how we do it.
Georgina, thank you so much for coming on today. Georgina Taylor, their head of multi-asset at Invesco. Coming up, we're talking cinema. French billionaire François-Henri Pinault is said to be in talks to buy a majority stake in talent agency CAA. Plus, drama in Hollywood as writers and actors strike. That's coming up next, and this is Bloomberg. Bloomberg has learned that creative artists agency is in advanced talks to sell a majority stake to François-Henri Pinault, the French billionaire behind luxury fashion house Kering. Now, a potential sale of the talent agency comes as the industry is hit with the first strike by U.S. actors and writers at the same time in 60 years. Now, for more, let's bring in Bloomberg Quick Takes Alex Webnut. First of all, Alex, to some this could have been a bit bizarre because he's really in fashion and luxury, but he is also married to Salma Hayek, so Hollywood is not a strange thing for him.
No, and we have seen particularly these French billionaires really diversify into some interesting things. They have actually, there was a very good story just this week about all the media assets owned by some of these big figures. The reporting is Bloomberg from sources that François-Henri Pinault is in advanced discussions to buy a majority stake in CAA, would value it at $7 billion. Of course, we saw one of their big competitors become a public company not all that long ago. Clearly, the market for going public not great right now. If they were seeking external investment, they must be quite happy they found someone because it's not a great market for that sort of thing right now. But it would be a substantial valuation for this company.
Yeah, and the industry is also going through massive strikes. I mean, it's the first time that we see writers and actors. So does that impact the deal, or is will it get fixed?
It's hard to know. Ultimately, if the strike is about actors getting better pay, well, the agencies work by getting a cut of the actors pay, so you would think it's better for them. I think this is actually probably more a private equity story. You know, CEA is backed by TPG, the massive private equity firm. What we're sort of seeing in PE at the moment is they often talk about the fact there's a lot of dry powder, but also a lot of the LPs, a lot of people investing in the private equity firms want to get that capital out, right, as they would do on a regular basis. That isn't happening as much because it's harder to get an exit. So what you're seeing PE firms do is sort through their portfolio and go, well, here are the really prime assets we want to keep for the long term. The ones that maybe aren't the prime assets, those are the ones where we're going to try to find an exit. Maybe the exit isn't as good as we might have hoped when we first got in there, but it's still better than nothing.
Alex, thank you so much. Alex Webb there from Bloomberg. Quick take, of course, focusing on media and tech. Now, coming up, Robinhood rival has arrived in the UK. We'll speak to Public.com's Leif Abraham. That's coming up next, and this is Bloomberg. Global stocks head for their best week this year on more soft inflation data from the U.S. and bets that the Fed's hiking cycle is nearing an end. Earnings season kicks off for Wall Street banks with results from JP Morgan, Citi and Wells Fargo due today. We'll bring you all of the pre-market moves this hour. Plus, luxury coat maker Burberry sees a muted rebound in China and declining sales in the Americas. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a couple of news. I'm sorry, it's Friday, so I wanted to bring you good news, but it's not good news. It's extra strikes at London Gatwick Airport. Now, we understand from union representatives that the workers are striking over pay, that the strikes will actually impact most of the airlines because some of these unions, of course, represent British Airways workers, EasyJet, Ryanair, TUI, WestJet, and Wizz. And we also understand that the strike will be for 8 days and it will start July 28th. I think they're working in between. So it's July 28th to August 1st and then August 1st to August 8th. And that's at Gatwick Airport. So my advice, if you travel anywhere, maybe just check with your airline that it will be, if not smoother than a flight being cancelled. Now, commission-free investing platform Public.com is launching in the UK, marking the Robinhood rival's first expansion outside its American home market. The firm will initially allow British retail investors to trade more than 5,000 US stocks and access additional services such as data and research. Well, joining us now is the co-chief executive and co-founder of Public.com. He's Leif Abraham. Leif, thank you so much for coming in and congratulations. This is an exciting time
Yes.
For you. So talk to me about the UK expansion. Like, was this always a goal to test the water in Europe, or why the UK?
Yeah, so first off, I'm German myself. My co-founder is Danish. We have an office in Copenhagen. We have people in Amsterdam and now obviously also in London. And so Europe always has been a little bit like part of our DNA, obviously. And for us, like our mission is basically to, make the public markets available and, accessible to all people. And that obviously includes then outside of that also people outside of the US. And so the UK was like a natural first step as like one of our first markets.
So how much do you trade in the US at the moment? And how much does size matter? So is it the bigger so that's name recognition so that people use your platform instead of a rival's?
Yeah, I mean, obviously, user acquisition is obviously a massive part for us, right? We want to grow and, going into a new market like the UK is obviously, you have 70+ million people here. It's a big market. And so that obviously is part of it. And, for us, really what we've seen is that from year to date so far, obviously retail investors are deep in tech, right? In the US T-bills are suddenly, cool again because, they're suddenly relevant again. And, we've seen, for example, the T-bill in the US has been the #1 investment year to date, even topping things like Tesla and so on.
So what are you expecting from the UK market? I mean, I have a 9-year-old at home who wants to be a hacker. I don't know whether that says more about, my family dynamic than actually some of the younger kids maybe getting into crypto at 20 years old and whether that really changes the market for you.
Yeah, I mean, obviously in the UK, we're starting off with trying to basically build the best experience to trade US stocks out of the UK. And, hence where we're starting with those 5,000 plus, US equities and, actual, zero commission trading and so on. What we've really seen is that things like crypto are in most cases also just like on-ramps for people to actually start in the markets, right? You've seen really throughout the last years that a lot of people started their investing journey by, for example, investing into things like crypto, and then from there actually diversify into things like SPY or their Amazon stock or whatever it might be. No investment advice here, but and so that's what we're obviously seeing, right? So crypto will not necessarily come in the US quite yet, but as we're a multi-asset investing platform in the US, obviously the ambitions are to have it in the UK as well.
But is there a retail trading culture in the UK, or do you think it will foster us more platforms that are actually widely available? So will the market grow? I'm Italian.
Yeah.
I mean, people, you go to the beach and people talk about the spread because they talk about yields. I don't know whether the UK is quite the same.
I would say totally, 100%. And I would say also in the market, you have to kind of differentiate between these like active trader platforms where you have your options trading, in Europe you have these like CFD platforms and so on, which is quite speculative and so on. What we've always been focused on is really portfolio builders. So people who invest for the long term, who build up portfolios over time, like we have a social layer to the app, and like hashtag DCA, which stands for dollar cost averaging, is like one of the most used hashtags on the app, for example. And so we've always been focused on the portfolio builder. And I think in Europe specifically, you definitely have more of like a savings culture. And that lends itself much more to that portfolio builder type as well. And so therefore, we're actually quite bullish on the European market, in general, and therefore also the UK.
So, Leif, talk to me about some of your, once this kicks off and kind of you see, I guess you met, a couple of months to see how it lands, then what's your biggest challenge? Is it to grow? Do you need funding to grow? Is it regulation? Is it kind of application or even tie-ups with banks and things like that?
Yeah. I mean, first I have to say that in the UK, you actually, have multiple ways of how you can get started in the regulatory environment, which is unusual to many other markets. And so, I've got to say chapeau to the FCA in that sense. Okay. And so therefore, that entry is definitely easier in the UK than it is in some other markets. And so for us right now, obviously, this is the first international market. So like, let's take it step by step, So we're onboarding first customers in the UK. We want to see how that goes. We want to make sure that everyone has as stellar of an experience as they can have, as they join public. And that's really the focus. And then from there, obviously, we want to grow and grow our member base in the UK as well.
This is great to hear. It's a bit surprising because you have a lot of companies or a lot of chief executives and saying, look, I find the regulatory environment in the UK quite difficult to navigate. They don't want to IPO here, maybe because rules are changing or are tough. So your experience has really been a positive one from what they, I guess, onboarded you. And how did it, how do you apply for a license?
Yeah. So the UK has multiple kind of pathways there, right? And so also like I think the actual like sandbox concept, originated here as well. And then you can go for your full license, right? We're right now working with a partner firm here. Okay. We're basically under their umbrella, which we're still registered on the FCA website and so on. But but generally like starting under that umbrella. And then obviously from there, there's still other ways of how you can mature from there further. But.
So how will you measure success in the UK? How much do you want to grow by in terms of is it customers or is it amount traded?
We care much more about customers, and we care much more about just like the assets we accumulate on the platform, right? So again, our business model is more centered around, the like to be aligned with the success of the user, and so we have pretty strong opinions about, not necessarily, being incentivized to have people trade a lot, but we really want people to build portfolios and be also therefore customers with us for a long time, not like burn out because if they traded for the last month, So that's just generally like how we kind of view it. And then from there, obviously, right, we're doing this as like to have another pool of potential customers to tap into, and so growth is definitely the number one factor, no question.
Do cool things. We're a little bit obsessed with Barbie and Oppenheimer and the fact that people go and see the two movies. I don't know whether there's any way of trading that from a retail investor, but is some of these stories that kind of really come in the public domain, does that help with adoption on your platforms, or is it a more serious crowd?
You might be surprised. So, for example, we have this community layer on the app, and so people talk about the markets and certain companies and so on. And there have definitely been some stories around, Mattel as a company and, the Barbie franchise and so on. Will that have an impact on the stock and things like that? But that definitely happened. I think the other piece that's also interesting, so in the US, we have an alternatives business, which really starts off with more like collectibles. So think of it as like fractional art, like you can invest in a piece of a Banksy, for example, and so on. And what you see there is that suddenly pop cultural events are also market events. And in our business, obviously, market events drive activity, and market events drive, acquisition of customers, and so on. And so that was kind of, obviously interesting to see with, the alternative assets as well. That the closer it is to pop culture, the more suddenly pop cultural events also become market events.
See, I knew we shouldn't have gotten rid of that Barbie doll from, the 90s. Leif, thanks so much for coming. That was Leif Abraham,
awesome.
Co-Chief Executive and co-founder of Public.com. Now, coming up, we'll ask whether commodities can make a comeback as U.S. inflation cools. We'll also speak to Anindya Bakrie, Chief Executive of the Indonesian conglomerate Bakrie Brothers. This is Bloomberg. The conversations that matter, the insights you need. This is the Pulse. I'm Francine Lacqua here in London. Now, it's been a terrible year for commodities, including nickel and zinc. But as U.S. inflation slows down, will this have an impact on the sector? Now, let's discuss this with one of Indonesia's major conglomerates. Joining us now is the Chief Executive of Bakrie Brothers, Anindya Bakrie. So thank you so much for joining us.
Thank you,
I can't
Francine.
wait to talk about commodities, but also the pivot to green, which I know is difficult. But when you look at commodities, first of all, how's it going? You're based close to China, and so I imagine that's one of your biggest customers. And we're trying to figure out how much commodity usage there will be in the future.
I think, first of all, Indonesia is well positioned because below the ground, it has all the critical materials such as nickel, copper, zinc, tin, but also above the ground, we can process them using solar, wind, as well as geothermal or hydro. So I think in the long run, in terms of the commodities that you talk about, Indonesia can play a role not only to the east, but also to the west. Because I think in the era of the supply chain being somewhat disrupted during the COVID, I think Indonesia want to play a role to make sure that it can contribute to this whole decarbonization story.
So how fast do you think that can come again? And we're seeing a lot of big superpowers trying to revisit some of their relationship with China. They talk about de-risking. What role, how long does it take for Indonesia to maybe be a reliable partner in that regard?
I think it can be very soon because right now, for example, our group just last year in December 2022 here in London, we made this consortium to send battery materials to the West using clean energy, ESG practice. And I think so far it has given a lot of big uptake from the West. And I think Indonesia is in a very good position because not only it can balance out the supply chain, but it will also bring the welfare for the rest of the people because there will be green industrial revolution going. And I think it can be an example of how things can be done nicely for all parties.
So what's selling at the moment? You talked about some of the technology that you're sending using green technology. How much better will this technology be? And so how much more scalable will it be in 2-3 years?
No, I think even in our group, and we are not the only one indeed, we are talking about helping the West with 120 gigawatt hour of battery factories. We're going to be processing using critical materials, using the ESG standard. And that's a lot because that can help about 2 million cars every year. And back to Indonesia, Indonesia itself is going through adoption of EV itself. Please bear in mind, it is a country, the fourth largest in the world with 275 million people. We start as a group with Vector, which we listed just last year. Vector is the pioneer of EV mobility in the country. We start with public transportation with buses. We have 200,000 buses in Indonesia as a market and 10,000 in Jakarta alone, which is bigger than London. So in Indonesia, it is also a story of electrification that will help also not only environment, but also health. Because as we know, 25% of the carbon dioxide emission is coming from road transport. In Jakarta, it can be 3 times more than that.
And I think you were one of the ones also trying to get Tesla, right, to have big implantations in the country. Have you spoken to Elon Musk?
We have talked to all the partners that we should. And right now, we're partnering with somebody who help us in public transportation, especially heavy mobility. And with our experience in auto parts business for 47 years, we're making one of the largest, if not the largest, Southeast Asia's factory for electric buses and trucks.
So you don't need Tesla, or do you? I mean, is there a prestige of having an Elon Musk factory?
Well, look, the most important thing is technology and capital, but also the understanding of how to work with Indonesians. Indonesia is a big market in itself. It is also the biggest market in ASEAN, which is Southeast Asia, total 800 million people. So I think Indonesia, with the critical materials, not only nickel, copper, and tin, but even bauxite to make the body of the EV can be done. So I'm not surprised that Indonesia can be seen as a hub for EV in the region by companies all over the world, as we have seen.
So, and will that increase again as some of the Western economies try to cut the reliance from China?
I think, we from ourselves, we like to cover both sides because I think stable, sustainable, and safe supply chain is very healthy, and that's what we want to do. So we have seen China come in, but, China, as, of course, the trailblazer, has done a lot. But I think the West, especially in the era of Inflation Reduction Act, and I think UK and EU will have certain portion of that, will also be an opportunity for Indonesia to carry on this initiative.
When you look at some of the critical minerals, and I have to say even some of them are frankly unpronounceable, and every couple of days there are some new ones, what do you think is the hot critical mineral of the future?
I think nickel is hot. Copper is also hot. Nickel is hot because some NMC battery 80% using nickel, but copper is certainly also the future because whether it's LFP, NFC, they will use copper, and the amount of copper being used is also tremendous. But nickel is what a lot of people are talking about in Indonesia, but not only nickel, but sustainable ESG processed nickel, and that's exactly as a miner we also want to do.
I also want to get, you mentioned the EV company that you IPO'd in Jakarta, I think last year. Is the market rife for other IPOs? We talk about inflation worldwide. I know there's, I guess, a little bit of volatility. How does it feel? Would it feel okay to list another company right now, or would you wait a bit?
Yeah, I think it is very much okay, Francine, because in the last 6 months of the year, Indonesia probably have seen more IPOs than any other country in Asia, and in terms of the size, and all of them are in the decarbonization story. So we have seen geothermal company listing, and also nickel as well as copper company listing, and of course our own heavy mobility company that listed. I think Indonesia is ripe to continue its fundraising, and I think the world should also participate and take notice on what is happening in Indonesia indeed.
Okay, well, wonderful. Thank you so much for coming on. You're a great poster child for, of course, your country. Anindya Bakrie, their chief executive of Bakrie Group. Coming up, spending on sport. Saudi's public investment fund is also said to be considering buying another European football club. So we'll talk football and the Middle East. That's coming up next, and this is Bloomberg. Now, Saudi Arabia has been making headlines recently for its big spending on sports. Bloomberg has learned that another football acquisition could be on the way. Our executive producer for the Middle East and Africa, Greg Tanner, has been following the story, and he joins us now. So, Greg, tell us exactly what's happening.
So, Fran, Saudi Arabia has had a stake in European football since 2021, when its public investment fund, which is the Sovereign Wealth Fund, took an 80% stake in Newcastle United. Now a source is telling us that they're looking at potentially another big football club from one of the main leagues. Now that wasn't going to be the case until very recently, because UEFA rules, they run European football, wouldn't allow clubs that had shared ownership to compete in the major tournaments. But all of that has changed. Within the last week, UEFA has allowed 2 English Premier League teams and a French team to take part in tournaments next year, despite their respective owners having interests in other teams that will be competing. And basically what our source has told us is that changes the maths for the PIF. They could now own a second team that would play in like the highest level of European competition. So they're in the market potentially for another team.
So for context, just how much has the Saudi money transformed Newcastle United's performance, Greg?
Well, when Saudi Arabia took the stake, Newcastle were 19th in the Premier League. They're on the verge of relegation. Next season, they're going to be competing in the Champions League. That is the pinnacle of inter-club football. It's where all the best European teams play together. because they finished in the top 4 last season. 20 years they didn't play in that tournament, and yet within a few years of the Saudi investment coming in, they're back in it after 2 decades. So I think that alone tells you of the improvement that they've seen since the Saudi regime sort of took over and started funding it.
So, and Greg, what are some of the other acquisitions that we've seen from the kingdom recently?
There's almost too many to list, but there have been many. The most recent really high-profile one came last month when we had the tie-up between Saudi's Live Golf operation and the PGA. That was quite a shock because they'd been competing as rivals for a couple of years before that. It's the biggest deal in the history of golf. Going back to football, they have 2 of the most famous players in the world, Cristiano Ronaldo and Karim Benzema, playing in their local league now, bringing it to the attention of the world. No one had really ever heard of the league before that. They even have their own F1 race now. 2021 marked the first Formula One race that took place in Jeddah. They've also been putting on boxing matches, Anthony Joshua, WWE fights. So they've really been pushing into sport as an investment and a soft power play, and now potentially might be on the lookout for yet another acquisition with another European football team.
Greg, thank you so much. They didn't get Lionel Messi. He's gone to Miami, and tickets are now flying off the shelves, but maybe they'll get someone else big. Greg, thank you so much, as always, for your great reporting, Greg Tanner, there for us. Now, producer prices in June also came in lower than expected yesterday following the weaker CPI print earlier this week. It has prompted the market to believe that the Fed's inflation fight is almost done, although they were probably believing it before because they were pricing in cuts. Joining us now is our markets reporter, Valerie Teitel. So, Valerie, when you look at, you know, the CPI and the PPI, are we basically now looking at deflationary pressures? Dun, dun, dun. Dramatic music.
There was a lot of good news this week for both the Fed and markets in general on this inflation fight maybe nearing a close, because a lot of the recent chat has been that getting inflation down to 4% was going to be the easy part, but then getting from 4% to 2% would be a bit more difficult. And I think this week's inflation numbers really poured a lot of cold water on that narrative. We're seeing a lot of progress on inflation, still without any big weakness in the labor market. And we did hear some quite hawkish comments from a important Fed member yesterday, Waller, out saying that the Fed is still going to have to hike 2 more times this year. But I would caveat that by saying that, look, the Fed is still going to communicate that they're going to be in a hiking bias until, you know, almost the meeting before they're about to communicate that they're pivoting to cuts. So not very much of a surprise that they're going to leave that threat of 1 more hike on the table, but the market isn't believing it for now.
Yeah, and then you have, you know, Mr. Waller saying actually 2 hikes, so 1 in July, that's 24th, 25th, and maybe another one.
Maybe another one sometime this fall, but the market really is not pricing that in at the moment. We're pricing in 1 and done from the Fed, and this big shift in repricing for that 1 and done narrative has seen, you know, the dollar weaken so much this week.
And the 2-year.
And the 2-year yields sink around 30 basis points. Equities are higher by almost 2.5% when it comes to S&P. So a lot of optimism in the market about this soft landing narrative that U.S. growth can still hold up while we rein in inflation back down to the Fed's target of 2.
Valerie, thank you so much. Valerie Teitel there, our markets reporter with some of the big moves, and they were big this week. Up next, the Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London, and this is Bloomberg. Happy Friday, everyone.